Hi, this is the Business Guy. Let's talk about the 12 best infrastructure stocks for America's big building spend. And these 12 infrastructure stocks represent several themes that could enjoy a boost as America's $1.2 trillion infrastructure bill becomes law. Now, one of the current administration's priorities has finally become a reality, a massive infrastructure deal that will usher in more than $1 trillion in new spending across 8 years to improve the nation's roads, bridges, rail, internet, water systems, and more. Now, a quick reminder, Biden's original $2.25 trillion infrastructure proposal would have been the biggest public works program in decades. In the president's own words, it would be unlike anything we have seen or done since we built the interstate highway system and the space race. But large proportions of the proposed bill face significant hurdles in Congress. For example, there were sections that addressed improvements to the home health care system and called for creation of jobs at prevailing wages and safe, healthy workspaces that critics said had little to do with what we might normally consider infrastructure. And now I need your help to keep the infrastructure of this channel. It really depends on you. So if you could click the like button so YouTube promotes this video, I'd really appreciate your help. And you can also click the subscribe button. It's totally free. And when you do, my videos will show up in your YouTube feed more often. So thank you so much. Now keep in mind, there's also the social spending bill in the works that is set to further our national debt, perhaps by $1.75 trillion. And this is on top of the $1.2 trillion infrastructure package that already passed. Now, Congress decided to put them into two separate packages and vote on them separately and to add to the $29 trillion debt. So, to put it into perspective, if it was you, what's the best thing to do if you have $290,000 in credit card debt? I know, just for fun, let's add another $12,000 to your credit card. And then just for good measure, we'll add another $17,500 to your credit card next month. So I say pay off your credit card first and then stop borrowing. And you don't justify it with GDP and all that. Just my opinion. I prefer not having payments and not trying to justify it with low interest rates because no payments are better than some payments. Just my thoughts. That said, the infrastructure spending is generally popular with voters. Hatred of potholes and gridlock seems to be one of the few areas of agreement between Republicans and Democrats. And I quote now, maintaining America's place as the world's premier economy isn't something that just happens, says Chase Robertson of Houston-based RIA Robinson Wealth Management. It requires investment. Most of that investment comes from the private sector, but certain things, particularly roads, bridges, and shared infrastructure, tends to be funded by the government. And the new administration has made it very clear this is a major priority, end quote. The new infrastructure bill, which was passed by the Senate in August, got through the House last Friday, and it boasts a $1.2 trillion price tag that includes $550 billion in new spending that would be a boon to traditional infrastructure stocks. So today, we're going to look at 12 of the best infrastructure stocks that should benefit from a spending surge from Washington. Now, this includes many names you typically associate with traditional infrastructure, as well as several unorthodox picks that a bill could bolster nonetheless. Now, special thanks to Kiplinger for your help on this list, and you can save up to 76% on Kiplinger Personal Finance by clicking the link below. And by the way, Kiplinger is not paying me anything for this little plug. They just help me, so I'm helping them out. Okay, so number 1 of 12, Vulcan Materials. Vulcan Materials. Market value, $26 billion. Dividend yield, 0.8%. Now, if you expect to see a lot of roads paved or repaired in the coming years, then it really makes sense to own Vulcan Materials. It's America's largest producer of construction aggregates, which includes things like crushed stone, sand, and gravel. It's also a major producer of asphalt and cement. Now, aggregates make up 76% of the company's revenues and 91% of its gross profit. Vulcan's sales mix is spread roughly between private sector buyers, primarily residential and non-residential building construction, and government buyers, primarily highways and building infrastructure. And even without a major spending bill, an expected increase in new home construction would likely be enough to give Vulcan's top line a meaningful boost. But with Uncle Sam looking to open his checkbook, Vulcan is likely looking at years of above-trend growth. And the Biden administration, just like the Trump administration, has shown a preference for buying American, and this should suit infrastructure stocks such as this Birmingham, Alabama-based Vulcan Materials just fine. It's as American as apple pie, with more than 360 aggregate facilities scattered across the country. And the company has been in business for 64 years, and it's considered the leader in the industry. Now, VMC is an obvious beneficiary of the new infrastructure bill. Okay? Now, number 2 of 12 is Martin Marietta Materials. Market value, $25.7 billion, dividend yield, 0.6%. Up next is Martin Marietta Materials. MLM could be among the best infrastructure stocks over the coming months or longer, because the story here is very similar to Vulcan Materials. And by the way, as we talk about these things, play this video in the background, listening to it as you get ready in the morning or in the afternoon or evening. Just keep on playing, because if you're investing in stock, you should really know what you're getting into. So make sure that you really understand this. Don't just invest based on emotion. Know what we're talking about here. It's really important for you to understand what we're talking about here before you put your money into a company. So really listen to this. I really want you to be informed before you put your money into these things. So Martin Marietta is a building materials company that specializes in the inputs used in large construction and infrastructure projects. Among other things, it makes crushed sand and gravel products, ready-mix concrete and asphalt, and paving products and services. Additionally, Martin Marietta makes magnesia-based chemical products for industrial, agriculture, and environmental applications, and produces dolomitic lime, hopefully I got that right, for the steel and mining industries. Apart from the infrastructure implications, you need cement and asphalt for roads and bridges, and Martin Marietta's chemical products are used in flame retardants, wastewater treatment, and assorted environmental applications. Now, Martin Marietta was heavily up and down for over much of the past 5 years, but in the second half of 2020, the stock finally started to build a trend and broke out of its range. It's now up 45% year to date in 2021, and it could have more room to run as the infrastructure funds are spent. Number 3 out of 12, Nucor. Now, this is a big one. Pay attention here. Market value, $32 billion. Dividend yield, 1.4%. Iron is primarily used in the creation of steel. So if you're bullish on iron or a producer like Vale, it generally means you're bullish on steel as well. And that brings us to Nucor. That's N-U-E, the largest domestic steel maker in North America. As Nucor described its place in the U.S. economy on its website, they say, "Steel is vital to the development and maintenance of America's infrastructure. Nucor's products have a proven track record in several of our nation's prominent structures, including airports, bridges, dams, and waterways. Our wide range of infrastructure products includes plate, rebar, sheet, piling, piping, structural steel, guardrails, signposts, and grading, to name a few." The Biden administration's preference of buying American should also give Nucor an advantage over its larger foreign competitors, such as Luxembourg's ArcelorMittal or Japan's Nippon Steel. These things are already going well enough for Nucor without the financial rush of infrastructure spending. The company took the unusual steps in February of pre-announcing that it is expected a first quarter earnings to set a company record. And it followed that up with a record net income in Q2 and then again in Q3. That also bodes well for this dividend aristocrat's ability to keep raising its payout. And pent-up demand for automakers and other industrial buyers coming out of the pandemic have massively boosted the demand for Nucor steel. Passage of the infrastructure bill is icing on the cake. Number 4 out of 12, Caterpillar. Now, what color is Caterpillar? You know, it's yellow, right? We know this company. Market value, $111 billion, dividend yield 2.2%. Now, a list of Wall Street's best infrastructure stocks just doesn't feel complete without Caterpillar, and that's ticker symbol CAT, easily the most iconic maker of construction and mining equipment. Now, Caterpillar's yellow trucks and machinery are found in virtually every construction site across the globe. It makes asphalt pavers, compactors, excavators, pipe layers, backhoes, and just about everything you'd need for a major infrastructure project. Between late 2017 and 2020, Caterpillar had traded in a range, and with commodity prices in the tank in major construction, mining projects few and far between, investors didn't just have a lot of enthusiasm for the stock. But then something changed. The shares bottomed out in March of last year, like just about every company, by the way, and then have more than doubled since then. And it seems investors figured out early that infrastructure spending would be a major component of any economic recovery plan. I mean, think about it. Roosevelt did that as well. Caterpillar is not just a pure play on American infrastructure. In fact, much of the reason for its poor performance in the years leading up to 2020 was the weakness in emerging markets, which had previously been a source of strength. But looking ahead, Caterpillar's exposure to emerging markets should be considered a positive. Number 5 of 12. Deere. Now, what color are they? Green. We know their equipment, farm equipment, so on, construction equipment as well. Market value, $110 billion, very close to Caterpillar. Dividend yield, 1.2%. Deere is known as a maker of tractors and other heavy farm equipment. But the company does a lot more than that. It's also a major producer of construction and forestry equipment, specifically the equipment used in earth moving and road building. Agricultural machinery is still Deere's biggest segment, of course. In 2020, the company sold $22.8 billion in farming equipment, but its construction and forestry business is also a force to be reckoned with. This segment did a very healthy $9.2 billion in sales in 2020, and more than 2/3 of that was specifically sales of road building and construction equipment. While Deere's construction equipment business is why it belongs with the infrastructure stocks, its larger agriculture equipment business should also enjoy several fruitful years ahead. Stimulus actions by the Federal Reserve and other central banks are helping to fuel a surge of commodity prices, including soft agriculture commodities. Higher prices tend to spur new cultivation. So don't at all be surprised to see a jump in sales in Deere's agricultural segment as well. Number 6 of 12, United Rentals. Market value, $2.8 billion. Doesn't have a dividend. We've established that there will almost certainly be a flood of construction spending in the years ahead, and that will create a sustained demand for equipment. Another way to play this trend is via the shares of equipment rental company United Rentals. United operates a network of 1,165 rental locations, 1,018 of which are in the United States, and runs 2 segments: general rentals and trench power and fluid solutions. The general rental segment rents out what you would think of as typical construction equipment: backhoes, forklifts, earth-moving equipment, booms, lifts, etc. The trench power and fluid solution segment rents out specialty equipment specifically designed for underground work and fluid treatment. URI shares cooled off a little bit last spring, but they have since restarted their advance, rocketing up 70% gains in 2021. And it seems Wall Street is already pricing in a surge of new sales. And that's okay, given the U.S. is about to spend $1.2 trillion to rebuild its infrastructure. There's still plenty of room for growth. Number 7 of 12, ChargePoint Holdings. Remember when we talked about in the video we just did that electrical charging for cars, that's going to be a major spending point. The market value of this stock, $8 billion. It doesn't give a dividend. Biden is serious about retaking leadership in the electric car space from China. And several of his initiatives from the American Jobs Plan survived the infrastructure bill. Now get this, among the green initiatives that Biden originally sought was the building of 500,000 electric vehicle charging stations across the country by 2030. Now, to give a little perspective of just how big this is, there are only around 115,000 gas stations in the U.S., so 500,000 electric stations he wants to build versus 115,000 gas stations there are now. So that's huge. That's something to know. So Biden's plan would have created more than 4 times the number of charging stations as gas stations currently in existence. Now, this isn't as far-fetched as it sounds. Charging stations do not necessarily have to be built to accommodate high traffic like gas stations and generally have less maintenance to worry about. So you can build a small charging station in an office garage or a mall parking lot, and you can simply add them to existing infrastructure. So some $7.5 billion in the infrastructure bill would be enough to deliver about half of Biden's original pledge, or roughly 250,000 charging stations. Still, this massive build-out should directly benefit companies such as ChargePoint Holdings. ChargePoint builds customized charging stations and has been in the business since 2007, long before electric vehicles were on the radar of most investors. The company has delivered more than 90 million chargers and claims 60% of the Fortune 500 companies as clients. Number 8 of 12, Oshkosh. Now, this is not Oshkosh Bagosh Overalls. This is another company. Market value $7.9 billion. That's with a B. Dividend yield 1.3%. Another major green plank for Biden's infrastructure plan was the electrification of the federal vehicle fleet, including the trucks used by the U.S. Postal Service. So this company makes vehicles, not denim clothing with built-in suspenders. So this company's bagosh is that Oshkosh is virtually guaranteed to be a beneficiary. For example, Oshkosh recently won the contract to produce 165,000 new mail trucks, a significant percentage of which will be electric vehicles. So EV maker Workhorse Group had filed a lawsuit contesting the contract in court, but it abruptly dropped the suit in September. And apart from its mail truck contract, Oshkosh would be an interesting infrastructure play for its other business as well. OSK builds specialty trucks including everything from heavy military vehicles to fire trucks, but many of its products are used in heavy construction projects as well. So Oshkosh makes cement mixers, truck-mounted cranes, and cherry pickers and other hydraulic lifting systems. Number 9 of 12, Freeport-McMoRan. Market value $54 billion, dividend yield 0.8%. Copper is a critical commodity in building and construction, as the preferred metal is used in electrical wiring and major components of plumbing. You can't really build many of these things without it, and approximately 43% of all mined copper is used in building construction, with another 20% used in transportation equipment. So if there was one element that would seem to be in demand for a broad-based infrastructure spending boom, it would seem to be copper. So if you're bullish on copper, then you're bullish on infrastructure stocks such as Freeport-McMoRan. Ticker symbol FCS. As for FCX specifically, it's one of the world's largest and best-run copper miners. But there's another angle here too. Copper is a critical part of the green energy story too. Electric vehicles use about 4 times as much copper as traditional internal combustion engines. So the transition to solar and wind energy will require major investments in copper as well. Renewable energy uses more than 4 times as much copper as good old-fashioned oil and gas. So any infrastructure bill spending earmarked for green energy should in turn help FCX. Number 10 of 12, Brookfield Infrastructure Corporation. Market value $2.8 billion, dividend yield 3.3%. Pretty high. It's hard to write an analysis on infrastructure spending and not include Brookfield Infrastructure Corporation. Together with its sister company, Brookfield Infrastructure Partners, BIPC is one of the largest diversified infrastructure stocks in the world, with operations spanning utilities, transportation, energy, and even data infrastructure. So Brookfield Infrastructure Corporation was formed specifically to give investors a way to invest in the company without having to own BIP's limited partner unit, which can be cumbersome at tax time. The utility segment operates 1,250 miles of natural gas pipelines and 1,350 miles of electrical transmission lines, as well as coal export terminals. Its transportation segment moves primarily bulk freight and commodities across its network of 6,400 miles of railroads, 200 miles of toll roads, and 37 port terminals. The energy segment operates about 10,000 miles of pipelines, and the data segment operates data storage and other cloud solutions. Brookfield really strives to be shareholder friendly. It targets a long-term return of 12% to 15% and an annual dividend growth of 5 to 9%, well ahead of the rate of inflation. So BIPC is not a pure play on American infrastructure by any stretch of the imagination. Its operations are global, but a rising tide lifts all boats. Number 11 of 12, Crown Castle International. Market value $84 billion, dividend yield 2.7%. Biden's campaign pledge and America's Jobs Plan also included a promise to provide universal broadband coverage. And that's also remained in the Bipartisan Infrastructure Investment and Jobs Act. And if we need a reminder of why fast and reliable internet is critical in a modern economy, we certainly got it in 2020 when millions of American workers and students had to adapt to working from home. And during the New Deal of the 1930s, the U.S. federal government dedicated major resources to rural electrification. This helped to bring poorer parts of the country into the modern economy far earlier than the private sector would have on its own. And today, the economics of broadband are different, And this is due primarily to the emergence of 5G mobile internet. It's a lot cheaper to blanket a region with cell towers than it is to string new cables. And that brings us to Crown Castle International, CCI, one of America's leading wireless tower real estate investment trusts. Crown Castle owns more than 40,000 cell towers, around 80,000 route miles of fiber supporting about 80,000 small cells. Mobile data usage will continue to grow at a blistering rate for the foreseeable future, and Crown Castle is a solid way to play that trend. CCI also happens to be a respectable dividend play, and its stated goal to grow that cash distribution by 7 to 8% per year. This is hardly a traditional infrastructure stock, and even without a nickel of infrastructure spending bill money, Crown Castle will be an intriguing long-term play on mobile data usage. But the potential for government largesse makes CCI all the more appealing. For another broad play on a boom in green-focused infrastructure spending, consider Eaton. No, Eaton isn't a pure play on green energy, but it is a major supplier of electrical components and systems. It is an important part of the story. Wind and solar farms have to be integrated into the national grid, and that's exactly what Eaton does. Eaton is a power management company with over a century of operating history. It has been traded on the New York Stock Exchange for nearly a century and has paid a dividend every year since 1923. That level of consistency in an industry so exposed to change is remarkable. Between 2013 and 2019, Eaton's stock price essentially went nowhere, but as plays on green energy started to heat up in 2020, Eaton's share price followed. With the market's focus now shifting on longer infrastructure plays, Eaton's run to outperformance could just be the beginning. So I hope you really enjoyed this. Hope it gave you some good ideas, some good information. And remember, this isn't investment advice. Don't take this as advice. This is just information. I'm just some guy on YouTube. So get advice from a licensed investment advisor. This may just be helpful information so you know what to ask them. So please click like, text a link of this video to others, share this video with others. I really appreciate you watching. This is The Business Guy.